banks love mortgages. It's a great long-term stream of income. I don't think they could have had this many mortgages on the books when interest rates were 2% higher, because there just wasn't enough demand. There is so much demand right now because most of the population is thinking the rate is cheaper, which it is. And the bank's thinking we're getting more and more volume out there. So over the long period of time, the longevity of these mortgages, we're going to make a ton of money. And they're right.
At IBCanada Group, we are your complete and independent source on the infinite banking concept, serving Canadians from coast to coast.
I think you just hit a great couple of points there. And just to confirm what we're talking about, we're not saying that if you can get a lower rate on your loan that you shouldn't take it. And if you're getting a better rate of return on your money, you shouldn't have that as well. But we need to throw off our consumer hat and we need to put on our banker hat. Start thinking the way that banks do and start thinking about the opportunity cost. And we're going to actually mathematically explain that. We're going to use an example of buying a car, but I think it's important that we recognize that every economic decision that we make, we are overly reliant on the interest rate rather than thinking about the total interest that we're going to pay over time or earn over time. And when we start using that as our lens, I think we will have a very different perspective over how we consider, should we pay cash or should we borrow? Should we be leveraging or should we not? Whenever we're making an economic decision.
I think the biggest thing, as you said, is let's take off our consumer hat and put on our banker hat, right? Looking at the same numbers from different perspectives, and we're going to see which side of the table is more desirable to be on. So yeah, let's get into it.
Awesome. Okay, cool. So what we have done is we've considered an example of, should I use cash to buy a car or should I use a loan to buy a car? What's interesting is I just talked to a person today in the car industry who says about 90 to 95% of the cars are purchased on finance. And the vast overwhelming majority is that the Canadian consumer doesn't have, in this example, $50,000. They don't have $50,000. They haven't been taught to capitalize. And I think that's a glaring omission in our financial planning. So let's just dig in here. We've presumed that the average Canadian buys a car every 4 or 5 years, and the average price of a vehicle seems to be climbing even more. But let's just say it's a $50,000 vehicle every 5 years, payments of just under $1,000 a month, and the interest at 6%. Fixed rate of interest over a 5-year period is going to cost roughly $8,000 of interest every 5 years. And of course, if we do this over and over and over again, then at the same interest rates, we're going to pay $8,000 of interest every time we take 5 years to pay a loan off. And what the danger is that we're ready to accept that $8,000 is a cost of doing business. It's a cost of it's our economic choice or decision. And when we think about using our cash, we are those who have cash are trying to avoid this cost. But Glen, what are they giving up?
They're giving up the right as owners of that cash to make better volume. It's the mindset again. They're thinking as a consumer as opposed to thinking like a banker.
Well put. So if we were to leave our capital alone and instead of deploying it to buy a car every 5 years, we just left it and we grew it. Let's assume that we're not paying tax on that 4%. Let's just assume that we're going to sit and earn 4%. Now, what's the better deal? And I'll ask you, Glen, what you thought it was when you first really started looking at interest volume over interest rates. And for me, it was a shock because I thought I was always making a decision on rate.
Well, I thought, come on, man, don't be ridiculous. There's no point paying out 6% when you'd only get 4 in your money. You're
Hmm.
way better off just using your cash and then just saving again for start the savings over again.
Yeah.
Right? It's simple math. There's nothing to think about, or is there?
Well, let's flip forward here and find out the interest that we would earn. So rather than take that money and buy the car cash, we've been taught to capitalize, we've been taught good saving habits, but now let's talk about wealth creation habits. If we were to borrow that $8,000 interest cost on the loan, but we made $10,832, obviously there's a bit of a pickup there. And this is the difference between compounding interest and simple loan interest, because we're paying on a decreasing loan balance every year. The interest is charged on the outstanding balance every month that we make a payment, and that's going down. So we're paying a lower interest cost, a lower interest volume. If we forward to the next time we buy a car in 5 years from today, let's just imagine that this was today, we made 10,800. The next time we buy a car, and we, instead of using it with cash, we get another loan, which we're paying another $8,000 for. Oh, because of the power of compounding, we're now making $13,179 of interest in that second 5-year period. And of course, we can tell where this is going. The third 5-year period, so between years 11 and 15, we're making $16,000 of interest if we left our money alone. Now, the difference, we want to compare the difference between what we are losing by using our cash to buy things. The interest differential is $2,800 the first 5-year period, $5,100 the second 5-year period, and $8,000 the third 5-year period. So in total, the power of compounding interest over that period of time is worth to us an extra $16,000 over and above the $8,000 every time we borrow. That's pretty powerful.
That's huge, Mike. You know, I never get tired of seeing this example. And I love to watch clients' faces when we use and show them things like this. Because understand, if you're 30, 35 years old and you're going to do this for up to life expectancy, we've got 3 periods in there. You could have 10 periods in there, right? And think about this. Look at the interest rate differential from each first period of time and to each subsequent period of time. What do you notice? You notice that even at a 4%, which is lower interest rate than the 6% being paid out, the volume of interest becomes like a snowball. And whoever holds on to this capital keeps on making that money. Now, for the vast majority of Canadians, it's not us. It's not them, I should say, right? Getting out of that. It's not them. But we're here to try and help more and more Canadians be the ones making this. Because as Mike, you mentioned brilliantly earlier, we get concentrating on the rate, not realizing, especially with amortized interest, we're paying the same rate, but we're paying it on a decreasing balance. Well, on the flip side, we're gaining the same rate here, but we're also gaining it and having it compound on an increasing balance. So again, volume beats rate, especially the more time you add.
Yeah, that's huge. For those of you who aren't numbers people, you're more visual people, we put this into a really complicated graph. And that's this. The opportunity cost, if this amount here is the loan balance as you pay it down here to zero over time, and then you reborrow again at this point and this point, and the loan balance is going down every time. This is what you were just explaining, Glenn, about you're paying it on a lower and lower balance. And therefore the interest cost is less and less and less. So even though the interest rate may be higher, the volume, the total amount of interest cost over time is less than just leaving it alone for 5 years, leaving your capital alone. And this is really the difference between this point end this point, right? This 50 to almost just over $90,000, you're getting an extra 40,000 minus 24,000. So it's worth that extra $16,000 to you every time that you're borrowing. So yeah, let's dive in a little bit to this amount. Glen, when clients see that differential amount and it's worth an extra $16,000 after interest costs, what are clients saying to you?
Quite frankly, after the disbelief, there's a little bit of anger there, right? Because the realization kicks in that I have let a whole lot of money on the table, right? And I'm upset that I didn't know that I could do something about this before, right? It's the matrix. Now you've taken the pill, you're going to have to make some conscious decisions going forward.
That's
but
very
the
true.
good news is the opportunity cost is there for you, right?
Yeah. Knowledge is one thing, but realizing that knowledge and using it in your life, you may know what to do, but I think working with an authorized practitioner of the infinite banking concept, of course, searching IBCanadaGroup.ca and looking for an advisor in your province to help guide and walk you through not only how to learn this sort of thing, but to dive deeper into your personal financial situation and help mentor and guide you through implementing how to grow, protect, and use the capital that you are freely giving away. At this point, it's ignorance. But after getting the information, ignorance is voluntary, and we can certainly help educate and teach you the financial literacy that we all learned as we came to know the infinite banking concept. As we wrap this up, Glen, is there any final thoughts that you have on this?
Again, as we go back to our topic of rate versus volume, just think, we're just using this for an example of purchasing a car, right? And we've used 3 time periods. Think of all the things that we spend money on over a lifetime. Think of all the capital that has gone through our hands. Think of the record profits that banks are making. And we talk about banks quite a bit, but rather than hate on the banks, we're saying, you know what, see what they do, emulate them. Now, you can't go open your own bank in most cases, but guess what? You can get your own banking system. And that is where authorized practitioners like ourselves can help you set that up and help you figure out ways how to use this and be efficient so you can be the one making the spread and, quite frankly, feeling fantastic about using your money, because you realize by controlling your capital and controlling the volume of interest that comes your way, the interest rate itself makes less and less difference as time goes by.
100%. Well put, Glen. Well, that's all the time we have today, folks. So for more information, again, I mentioned the website, but just to give it to you again, IBCanadaGroup.ca. I highly recommend that you sign up for our masterclass and the Q&A to that masterclass, or find an advisor to help walk you through that process. Glen, thanks for your time today. Really appreciate it. Look forward to seeing you again soon.
Go to our chat, Mike. And don't forget, subscribe, hit the like button, and let us know what you think. Thank you.
IBCanada Group, your independent authority for information on the infinite banking concept.